Hey everybody, welcome to week 63 of the Ag Commodity Corner Plus podcast, and today is the 19th of June 2026. It's a short holiday week, but it was a big week for the markets nonetheless. Mo, what's our topic for this week's podcast?
Yeah, so this reopening of the Strait of Hormuz is bearish diesel fuel and fertilizer prices. If you've been watching these podcasts, we've been forecasting this, and we thought it could happen just shortly after planting season. So let's get into it. Here's your weekly summary quote chart, and a little bit more green on the screen finally this week. We're maybe carving out a bottom in the grains. You can see soy oil was off, and so was canola. I think this canola correction is a little bit overdone and overshot the mark, but we'll get into that. Dow, new record highs. S&P, NASDAQ, a little bit shy of those highs. Crude oil, obviously down 734 because of the reopening of the Strait and this peace deal. And, of course, the U.S. dollar finally breaking par, 100. They didn't really like the tone from the new Fed chair, Kevin Warsch, and we'll talk about that as well. So let's start off with this peace deal.
A US-Iran agreement to extend the ceasefire between the two countries has been signed digitally, but the signing ceremony physically has been delayed. The 14-point agreement, which is known as the Memorandum of Understanding, says that Iran will never have a nuclear weapon and also commits a $300 billion fund for the reconstruction and economic development of the country, although the U.S. is not required to contribute. This peace deal obviously has been affecting the markets, and the reopening of the Strait of Hormuz, like you said, Mo, is bearish. Farm diesel prices and fertilizer. WTI crude oil futures broke to its lowest since early March 2026, and U.S. gas prices fell below $4 per gallon for the first time since the 30th of March. And this is the longest straight drop in gas prices, so for about 28 days, and it's the longest since November 2023. Also on fertilizer, US average retail urea prices dropped by about 12% week on week to 764.
So let me go back to the first image of the 14-point plan. Vance and Trump don't want to give Iran $300 billion for reconstruction. So we'll see. I think that this is a 60-day pause. We'll see what happens in the next 60 days. As of yesterday, 12 million barrels of crude oil had transmitted through the Strait. As of early this morning, the Strait was closed again because I guess Lebanon was striking Israel and vice versa. So, is the peace deal in jeopardy? I don't think this thing's going to go smoothly. So expect some of this noise, but let's assume it's for real, it's done, it's over. And long-term, this is bearish crude oil. Anything below 76.63 takes crude much lower. The IEA yesterday said there's going to be a glut of global oil supplies. Next year, they're going to grow by 8 million, while demand only grows by 2. OPEC doesn't agree. OPEC's been increasing production, so we'll see. You can see here, back to this chart for a second, that you have to, when you overshoot the mark here, you got to go back to the mean. That's what we've taught you after a year of podcasts. And guess what? They're going to take and overshoot the mark to the downside. So we would not be surprised if we go much lower. Here's U.S. urea FOB, and we're down to this 400, but I'm hearing quotes in the U.S. at 340. I'm hearing Western Canadian producers giving me quotes of 460 on 28%. We got as high as 700. Urea at 760, 750 if you store it, 790 if you buy and store. Some farmers don't like storing that urea because when you store with high humidity and heat, it actually does damage. It turns into a block. So some prefer let the supplier retailer store it. But look, at the end of the day, you can see what happened in 22. I think there's still another $100 to the downside risk. So you decide what you want to do, but prices are coming in lower. We still need more help with grain prices, but we'll get to that at the end. Keep you under suspense. Soy oil, if crude has peaked, that means soy oil has peaked and so has canola.
So like you said, Mo, a peak in crude oil equals a peak in soy oil futures and a peak in canola futures. Soy oil, as is shown on the chart, has pulled back from the peak, but still higher for the year. It is off by almost 14% since early June. Canola is off by over 9% since early June.
So let me go back to this chart in soy oil. If I bring up a daily chart, we've done damage, obviously. And there's a head and shoulders top formation. This is a weekly. The weekly, to me, gives you a better picture because I think the funds overshot the mark here to the upside. This is your long-term bullish trend because of 45Z and the RVOs and all that fun stuff. And so I think we're taking a short-term break, obviously, because of that lower crude. But the long-term 2-year uptrend remains intact. And I think at some point we just resume. We just got to buy time, take a break. Corrections are always healthy, and then we can move forward. This is your soybean crush. It's come down just like canola crush has come down. We hit record highs not seen ever, and so that's also weighing short term. This is canola. You can see the damage here, but I think this is overdone. Short term, you can see the RSI down into that 30 and change. So we've done some damage on the charts, obviously, but we talked about this last week. Remember about all the moisture and flooded acres and unseeded acres? We keep talking to farmers and they've all lost acres. There's probably 1 in 10 that did not because they didn't get the rains, but for the most part. And I think the market's going to take a long time to figure this out. I think some entity of some sort like Stats Canada, AAFC, is going to have to tell you that story. But we're not too concerned about this correction. I think demand remains quite strong. And then if you have a subscription to ProfitX, DTN, or Bloomberg, you can get this updated chart. I couldn't find one. I don't have a subscription to either one. So I know that canola crush margins got as high as 400, now back to 300. So again, a little bit of a correction in those margins are weighing short term on canola futures.
Well, let's look at the stock market, and there's no way skipping the stock market any of these weeks. The much-awaited SpaceX IPO has increased Elon Musk's net worth to 1.3 trillion on the 16th of June 2026, and that was up by about 300 billion in one day, which is more than what Warren Buffett made in his entire lifetime. SpaceX aimed to raise 75 billion in its IPO, but it was priced on June 11th at a valuation of 1.77 trillion, making it the highest valued IPO, with common shares opening for public trading on June the 12th.
So this is the June 16th, and when SpaceX got as high as 225, it pushed Elon Musk's net worth to 1.3 trillion. I don't know if you guys remember Charlie Munger, his right-hand man. He passed away.
You mean Warren Buffett's right-hand man?
Right. Sorry. Not Elon Musk's. Maybe he has one. I don't know. But he said the first 100,000 of BITCH. I think for Elon Musk, the first 300 billion was a BITCH. Everything after that is easy peasy. Crazy world. This was a wow moment. That's why I wanted to show it. And we told you what to do last week in the podcast with SpaceX. So if you want to know what to do with SpaceX, go back and watch last week's podcast. Don't forget to try our program, our app. This week we were talking about, did we hit lows in June for the grain markets? We give our reasons why. So we'll see what happens here going forward.
This week also was a major week for the U.S. Federal Reserve. It was the first FOMC chaired by the new chairman, Kevin Warsch, and the U.S. Federal Reserve kept interest rates unchanged at the conclusion of the June meeting. Americans hoping Warsch would deliver lower rates are sidelined for now. The new Fed chair was too hawkish and hates providing guidance and visibility on interest rates. The US dollar index broke below 100.
So Warsh reminds me of Greenspan. I think he wants to move away from the Fed providing the guidance. He wants markets and businesses to provide the guidance. So this will open up the markets to more surprises. You will probably not know what he is going to do at the next meeting. 9 of the members wanted to lower rates, 9 wanted to hike. Everybody still thinks that maybe there's a hike by year end. I don't think so, because this higher inflation was a one-off, war, transient. I think inflation will collapse, and when it does, we'll have lower interest rates on the table, but maybe that's been postponed till 2027. In the meantime, the US dollar didn't like it. We finally broke above par. We've been trading at this par for almost 2 years. And we could, if you take a Fibonacci retracement from the 2022 highs, you can go up to this 200-day moving average at 102.68 or as high as 107. You get, and because we've probably postponed doing anything on interest rates until year end because of midterms and all that fun stuff, this is bearish Canadian dollar. The Canadian dollar is breaking down almost at new lows at 70.59, and I think we could go and test that 69 cents. So that could be bullish basis in Canada.
We also had the latest monthly cattle on feed update from the USDA, and that could be deemed as bullish. The US cattle on feed numbers reflect a unique moment for the industry, given the fact that the US beef cow herd is sitting at a multi-decade low, yet feedlots are gradually accumulating more market-ready cattle. Fortunately, feedlots remain current in their marketings and are able to capitalize on these strong cash values.
You know our view on cattle. It's a bull market, period. Nothing's changed. This report changes nothing. Over time, we'll just continue to head higher. This is live cattle, and then this is feeder cattle. I don't agree with the chart here that there's lots of downside. There's actually a lot more upside moving forward.
And a recent study by S&P Global and the U.S. Farmers and Ranchers in Action warns that the U.S. could lose roughly 30 million corn acres by 2050. This loss is projected to occur if ethanol blending rates remain at 10% with E10, and new demand for maritime or aviation biofuels, if they are not developed, that is the case, which basically means that we need E15 mandated as soon as possible year-round. The study also says that biofuels stand out as a uniquely powerful catalyst with the potential to restore long-term profitability to U.S. farms, and it says that the global biofuel output could triple or more by 2050.
So I think obviously this will be, we'll lose corn acres to bean acres, and I agree with them. If you don't find another corn demand source, I think that higher yield over time is just going to produce too much corn. And what are we going to do with it? We can't rely on trading partners to export it. Maybe that changes. But not only do we have to go to 15% E15, but what about E20, E25, E30? That's what Brazil's doing. That's what other countries are doing. We need to wake up to this, because this report was doom and gloom, but they make a point. We need to, what are we going to do if we increase the yield over time? What are we going to do with excess corn supply in the United States? So, and then finally,
let's look at the Chinese purchase tracker for 2026 US soybeans, so the commitment tracker. Currently, if we include unknown sales as well, it stands at 2%. So there's been some Chinese purchases, but we need more volumes. Without the unknown included, we are at 0.5%. So as of now, 24.496 is what seems to be remaining as far as the goal of 25 million is concerned.
Guys, we've been hanging our hat on this for some time. I know the funds are disappointed. It's taking too long. I'm not surprised. Go back to 2020. Go look at what happened. It took a while. In 2020, China bought 90 million bushels of corn. In 21, they bought 787 million, up 952%. In 2020, China bought 951 million bushels of beans. In 2021, 1.1 billion. 2027 is going to be a repeat of 2021. What do you think is going to happen when China buys 900 and I think it's 15 million this year? That 25 million works out to about 900 and change. They got to buy about 1 million metric tons per week. The current state-owned entities are buying, so the 372,000 we think was China. I think the trade thinks it was China. So that's why we included it in the 504. But we're separating it here because we want you to know that it's unknown. It was not China. The 132 from the other day was China, 132,000. So they're going to have to buy about 1 million metric tons per week from now till the end of the year. I don't think the market's getting too excited yet because you're lacking the volume and you're not getting buying from Chinese crushers. I think once you lift or lower the tariffs, and they start buying, you start getting that volume. When you start getting the volume, that's when this takes off. So fertilizer prices are dropping, but grain prices suck. What could change that? Right there, Chinese demand. Thanks for watching. Don't forget to subscribe to the channel. Have a great weekend, and happy Father's Day to all the guys out there. Take care.
Bye, guys.